Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Stocks snapping a two-day losing streak. Optimism on Wall Street driven by big tech and chips, plus earnings from Morgan Stanley and Goldman Sachs. The AI boom not showing signs of slowing down. One of the key pieces of the build-out, data centers, the rapid expansion raising some political concerns, and we're looking at the implications for investors. And the future of electric vehicles in America. It's been a bumpy ride for automakers, including Ford. Coming up, a conversation with Ford CEO Jim Farley on the road ahead. Well, while commercial real estate faces a challenging backdrop with uncertainties surrounding tariffs and interest rates and inflation, our next guest sees bright prospects for a new real estate cycle. Brian Klinksiek, Global Head of Research and Strategy at LaSalle, joining us now to discuss. Brian, it's great to see you, especially on set. Let's focus on maybe the U.S. market here, Brian, just to start. So the commercial real estate market here, I'm just curious, what do you see broadly in 26? How's it going to compare and kind of contrast to 2025?
Well, we just put out our annual outlook. And every year we sit down and kind of develop a theme. And when we did that this year, the theme was the dawn of a new real estate cycle. The problem was that was our theme last year. So we thought about it and said, just feeling a little like Groundhog Day. 2025 wasn't the year of acceleration that we had expected. There was some turbulence around tariffs and Liberation Day. But the conditions for a positive turn in real estate markets are all in place. We see those as prices in line with bond markets and valuations in line with prices, increasing real estate debt capital availability, and the conditions for a rebound in real estate fundamentals, which have been impacted by some supply. And all of those three conditions, which were in place to some extent last year, are in place to a greater extent this year.
Let's dive into some specific verticals. Talk about office. What do you see there?
Return to office is continuing to come back a little bit. We don't see return to office as the primary driver of the investment proposition in office. For us, it's the CapEx that's required. People are excited about the improvement in office fundamentals. We predicted it a year ago. Vacancy is just starting to fall. High quality segments are doing even better. The problem is we do see some investors already starting to go back to their prior mistakes, which is assuming that office space doesn't take a lot of CapEx to keep tenanted and to keep modern. So we're monitoring that. It's not one of our top preferred sectors, but we do find some opportunity.
What about that theme you heard a lot about, Brian, at one point, kind of refurbishing office to residential? I mean, was that a real theme with real traction?
That's happening, but it's not happening at a large enough scale to really move the needle in a lot of markets. And sometimes, in many cases, it requires some kind of subsidy or incentive to make the numbers work. One of the problems is that most office stock built after World War II, the floor plates are really deep, and just the economics of making it work for residential really aren't there. And so while this will be a factor in help resolving the oversupply of office space, it's going to take time and it might take some public sector engagement.
So that's office. What about industrial, where you sounded more constructive?
Well, the thing that industrial has been dealing with recently is just a wave of supply. It was the darling post-COVID. Vacancy fell to never before seen levels. Rents were popping. That stimulated new supply. Since then, inflation has pushed up construction costs. Developers know they can't exit these assets at the same prices they could before yields went up with the inflation. So we see today is vacancy having spiked up a bit, but it's starting to fall as supply pipelines empty out. So we see really across all of real estate, except for data centers, the development of new stock is falling very quickly, and that will underpin a revival in rental growth.
How about apartments? What are you telling clients for the year ahead?
Generally, we like apartments. There are pockets of oversupply that are being worked through some of the Sunbelt markets that were very hot. We really like the affordable housing segment of apartments, in particularly in places in the US where the gap between affordable housing rents and market rents are significant. That tells you that that kind of product is needed in those markets. And we think it's a really low risk way to invest and also helps solve a social need.
On AI, you suggest here AI's impact on real estate, incremental, not transformational. So as you look at it, Brian, okay, what changes, what doesn't?
Well, I would really bifurcate that into the AI and the way we use it as investors, and the AI as its impact on real estate markets, the economy, and demand. I think there's a whole spectrum of perspectives on the latter that range from it's going to change everything and we're not going to need all these office workers to it's a bubble and it's a lot of hot air. I think a view that's somewhere in the middle is probably the right view to take. There are people saying that this K-shaped jobs recovery is down to AI making people's jobs irrelevant. What we find when we look at the employment market is that it's not AI that's causing the slow hiring, it's overhiring in the post-COVID recovery. So we don't currently see it as driving this slower job growth, which is a factor that we're looking at. On the investment process side, we're using AI to dig into the data that we have, through our partners, through our parent company, to really take our research to a higher level and find trends that are maybe less apparent.
Finally, Brian, we've been talking about the U.S. here, but I know you also think globally, right? So how do you see sort of the real estate cycle in 2026? How does it kind of develop and diverge, U.S. versus Europe versus Asia?
Yeah, I'll make 2 points, one about Europe and one about Japan. In Europe, what we have today is an interest rate divergence versus the U.S. Both short and long rates fell sooner and more sharply than they've fallen in the U.S. And what that has meant is that when you borrow to buy real estate, you have positive leverage on day one. Whereas in the US, often you have to underwrite rental growth to get positive leverage, meaning your leveraged return is higher than your unleveraged return. And that's return animal spirits to the European property market a little more quickly. Now, Japan's an interesting case. On paper, you'd look at a market with rising interest rates and you'd say, that worries me a little bit. But what's happening in Japan is not just a cyclical thing. This is a structural return to a more normal economic environment where you have some inflation, but you also have growth. So rents are growing, and that hasn't really happened in Japan for more than a generation. Mm-hmm. And so the real estate market there, people in that market aren't used to trying to actively manage real estate to capture that rental growth. And we think that there's an opportunity to be smarter and moving from that deflationary mindset, which Japan was really stuck in, to a more inflationary mindset that's more typical of the rest of the world.
Brian, always good to see you, especially on set. Thank you, sir.
Thank you. Great to be back, Josh.
Stick around. Much more Ask for a Trend. That's still to come. U.S. stocks bouncing back from 2 consecutive days of losses. And here with the trading day takeaways is Yahoo Finance's Jared Blikre. Jared.
Thanks. We got to talk some records first. And let's just get to that on the Wi-Fi Interactive. Records galore. I'm going to start with the S&P 500, which did not close at a record. But I just want to show you the last 9 months. This goes almost back to those scary April post-Liberation Day lows. You can see it's up about 28, almost 30%. But it's essentially flatlined over the last few months. Meanwhile, check out the Russell 2000, small caps, what they're doing. This already went through its flatline consolidation period, and it is broken to the upside. Here's the S&P 400. These are mid caps in a very similar chart right there. It was going flatline forever, then it used the prior ceiling as a floor, and then it just took off. Also want to show you the micro caps because those are hitting record highs too recently. And look at that, 58%. That's more than double the S&P 500. There's also an iShares ETF called IWC. That's the ticker. It is up 10 straight days. You have not seen that since September of 2017. So smaller is bigger than large right now. And that was kind of my thesis from yesterday. And this is just an extension of it.
You know what else we have to talk about? Chips.
Yes. Taiwan is in the news. So chips are ripping here, semis are soaring, and let's take a look at a heat map of the chip sector. I'm going to show you what happened today first, and we're talking about what, another $500 billion in investment in domestic chips. And here we see Taiwan Semi up 4%, Lam Research up 4%. Let me just show you the year to date here. We're only midway through January. I'm going to sort by performance here so you can see some of the outsized winners. SanDisk up 72%. We're halfway through January. Applied Material up 43%, Intel up 30%, and the list goes on. You see a few in the red here, but not many at all. Broadcom, I think, is a big exception, and so is NVIDIA. NVIDIA is just barely positive there. So you put it all together, chips looking very bullish.
You know what goes into those chips? Silver.
Ah, yes. And guess what? Guess what hit a record high today? Silver futures once again up to $93 per ounce. And I was checking on the gold to silver ratio. That's one of the ways that people measure silver prices and gold prices on a comparative basis. And it is down to 51 from over 100 about 6 or 9 months ago. So let's see if we can find silver SI equals F in here. Well, even if we can't, you're just gonna have to take my word. It hit $93 and change. And I do want to get to this because we were talking to Kenny Glick. He is the owner of Hit the Bid. He operates a trading room, big silver proponent, and he carries silver coins in his pocket every day. He had to say this about the silver rally.
And that's a frightening thing when it's a crowded trade.
Yes.
But also on the flip side, when people see this monster parabolic move, the shorters get involved. Mm-hmm. And again.
And then they're the fuel.
Yeah.
Oh, show.
Yes, yes. And the shorters are generally, they're wrong, okay? Because they see this move, just like in the markets, right? Just because something has gone up parabolically doesn't mean it has to come crashing back down. It can consolidate, just like that whole overbought thing.
Yeah.
If something's overbought, sure, but if it stays overbought for a given amount of time, it's no longer a correction. The overboughtness it kind of dissipates.
That episode is going to drop Tuesday, so we got a few days until then, but look out for it. Kenny Glick, that was his 6th appearance on the show. And I found the silver chart. Thank you, producers, in my ear. It was in the upper right the whole time. Year to date is up 30%. Let's check out the 1 year, 194%. So basically the price has tripled over the last year. Put on 2 years and you got 302%. So quadrupled, and that looks parabolic. And like Kenny was just saying, markets can go parabolic for a long period of time, but silver has been consolidating for a long period of time. And when it breaks out from a multi-decade base, this thing's got some juice. That's my thesis.
You want to end here on Bitcoin?
Let's do that. We got a little time left, so let's get the crypto board up. And Bitcoin is down 2%. I was just saying that Bitcoin had just confirmed a short-term uptrend, and hard to see in this chart, but basically it broke this resistance level, so it is now stair-stepping up. It's using the prior ceiling as a floor. That's what you want to see, so that's normal. But I want to see 95,000 hold, and this is the fledgling rally that the bulls have to win. As always, I do like to include the levels that I'm watching here. The make or break line for me is 110,000, so 15,000 away from that. You break that, it's, I think, an easy trip to new highs.
All right, thank you, buddy.
You bet.
Appreciate it. Coming up, much more As for a Trend still to come. Automakers are facing a challenging landscape with a mechanics shortage, EV slowdown, and uncertainty around tariffs and trade. Ford CEO Jim Farley joined Yahoo Finance's Praz Tumaranian at the Detroit Auto Show to talk about all of that and the rising competition in China.
We're a year down the road with the Chinese competitors. They're now even more prominent around the globe. Not a lot here in the US, but you go to Europe, you go to anywhere else, China's a big deal. Number 2 is partial electrification, hybrid, EREVs. EVs are now starting to change, and the partial electric world is actually the most exciting part of the, and then I would say, tariffs are still a big topic. And that's something that's very much on our mind in managing.
Yeah, I know President Trump talked about, do we need USMCA for Canadian products? I know you have thoughts on that.
Yeah, USMCA is critical for our country. We developed the whole assembling automobiles across all 3 countries. We need revisions to it. It's not fit for purpose today. The tariffs do change a lot. About the aspects of USMCA, but for a company like Ford, who makes the most number of vehicles by far in the US, like 80% of what we sell are made here, our competitors aren't even close to that, the mainstream competitors. This is a critical negotiation. It should start sometime this spring, and I think every customer should care deeply about USMCA.
You mentioned China as well, and their EV prowess sort of front and center with the industry. Yes. Ford with the pivot last year at the end of the year, kind of going more towards the smaller EVs and EREVs and
that's right,
and however you want to say it.
Exactly.
What do you think the industry, Ford, even us journalists and Wall Street got wrong about the EV transformation, or is it just a delayed sort of onset?
No, it's not delayed. I think it's actually different. I always portrayed it like a baseball game. We were in the 2nd inning. Most people thought we were in the 8th inning. We were actually in the 2nd inning. We're now going in a 3rd inning. And I think all of us should be humbled by the fact that we're at the very beginning of this journey. We are not in the middle or the end. battery tech, infrastructure. It all changed a lot. It took us 100 years to build out the petrol infrastructure. The electric infrastructure is going to take a lot of time. It may not take 100, but it's going to take time. I think what we got wrong, I think what we all got wrong is, look, policy has a huge impact. When President Trump says no EPA rules anymore, that is a game changer for the companies. We were artificially selling EVs and hybrid at mixes that were not in line with customer demand. Now we're doing that, and that changes your allocation of capital. But I think anytime a new technology, software-defined vehicles or electrification, both of those are separate, but they're connected. When they rip through a new industry like auto, you got to understand that in the first couple innings, it's going to keep changing differently than we think. And I like to say those pesky customers, I love that term because the customers are awesome and they act rationally. They're not going to buy a $70,000 vehicle that only goes 300 miles if they don't really want to charge on the fly on a long trip. And we drive long distances in the US. And we found out they're just not going to do it. Some people will do it at a Tesla Supercharger now, or a Lightning customer or Mach-E, but most customers are like, nah, I'll buy a hybrid, and we think they'll buy an E-Rev. That is a really cool tweener technology.
Yeah, that Lightning E-Rev coming up in a couple years. With,
I think people will be shocked. It's an all-electric vehicle.
Yep.
It is not a hybrid like the F-150 hybrid. It doesn't have a gas powertrain to drive the wheels. The gas powertrain is an industrial engine to charge the batteries. It's a completely different vehicle, but for towing, work use, long distance, it's an electric vehicle that can power itself with gas charging.
I know you did that EV road trip in America, and kind of curious how that would be with the E-Rev, right? Maybe a different story altogether.
Yeah, I wouldn't
right?
stop.
Yeah,
I wouldn't be stopping at Supercharger Networks or Charge America. I'd be stopping at gas stations.
Speaking of gas stations, we're in Detroit, Motor City. You guys unveiled 2 cars here, specific cars, enthusiast cars.
Yes.
The Dark Horse SC, which is sitting right there across the way here. Also the Bronco RTR.
Yes.
2 different products, but targeting enthusiast customers.
Yes.
Why is it important for Ford?
That's our whole brand, no more boring cars. What I love about both products is Vaughn is something new for Bronco.
Vaughn Gittin.
Vaughn Gittin Jr., like his whole DNA was a drifter. So like Ford's working with him on an off-road vehicle, but he's been racing at Baja with us. And he loves off-road racing. And also the SC, it's not Shelby. It's something different. We're going in a different direction now. We really want to connect our vehicles to racing. With the Mustang Challenge and our GT4 and GT3 race cars. We really see Mustang lineup being built out around as an enthusiast brand. Yes, you could rent one in Florida and drive it down to the Keys as a convertible. But I think we really feel like Porsche shouldn't be the only brand having fun, and we're going to do it in a Detroit way and differently. We want to make a stick shift affordable V8 coupe, unlike some of our competitors here in Detroit. But we also want a drift RTR Mustang. We want a supercharged, more affordable version of the GTD. We want a GTD. We want Bronco to not be just the old style off-road. We want Vaughn Gittin Jr. to remix an off-road category. We are not going to be stale trail people only. That's what's fun about being in the car business. We want to challenge ourselves to reinvent the enthusiast products on and off-road in a way that maybe people didn't expect.
I know you're really hot on Dakar and with the Bronco there, and you guys, knock on wood, have a good finish there. I know. Yeah. I know you want to talk about that, but also we got to mention the season launch today. Formula One. Ford returning to the top flight of motorsport.
Yes.
It's a big deal, obviously, for American fans and for the F1 in particular. But it's not just a marketing exercise, which many people thought. Right. It's beyond that. It's engine and DNA, right?
Yeah, we've been working for 4 years. We have lots of engineers in Milton Keynes. It's been a lot of work for 4 years. Today we get to celebrate that, and then we'll be on track in Barcelona and beyond. It's going to be very challenging. We are not like Ferrari and Mercedes have been building a PU for 20 years. The DFE got us to the 3rd most winning brand in Formula One. with our power unit. But the tech transfer is no longer 4 valve per cylinder and overhead cams. It's now, predictive failure components and software that we can put in a transit van, or, more aero that we can put in the new UEV affordable electric vehicle, or high discharge batteries that we may use in a performance hybrid system, that we can transfer from Formula One. So the tech transfer, and that's kind of our bet in Formula One on the PU side, the power unit, is really to move that tech into our core product, but not in the old school way of powertrain. It'll be in areas like, batteries, software, and aero.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.